What's up, guys? Hope you're keeping well. In this video, we're going to be talking about reserves. So reserves are used in insurance and that sector. It's like a lump sum of money that insurer sets aside to meet future policy obligations. It's just the present value of future benefits and expenses minus present value of future premiums that they're expecting to receive. And this just ensures that the insurer can pay out future claims. It matters because of solvency. It provides policyholder security, and it's also a regulatory requirement in the real world. In the real world, there's standards that specify how they must calculate how much reserves these big corporations need to keep. Because you can imagine you can't just keep writing a bunch of policies, but you don't have any reserves. So, like, where's the money to pay out the claims and stuff? But yeah, let's get into this. I'll start by writing out the formula that I just said. This is the one we're going to be using. So this is we're minusing the future office premiums that we're expecting to receive. Yeah, there's not much to this. Let's just jump into the questions. An insurer issues a whole life policy for a person now aged exactly 55. Remember this policy, whole life policy. This means that whenever this 55-year-old dies, they will be paid out an amount. We'll say how much somewhere here. Premiums are paid annually at the beginning of each year. Death benefit is paid at the end of the year of death, and reserves are found using the gross premium policy values. So the death benefit, when he dies, when this person dies, they're going to be paid out $60,000 at the end of that year. Should we highlight that? That's the amount. Premium per year is 1.6, and this is paid in advance, beginning of each year. And then we've got costs, which is like an expense, $85. Interest is 4% per annum, and expenses are paid at the start of each year. So this expense is paid in advance. Cool, so now we've got everything we need. I've put these values here. This is all that we should need because I'm not adding any live tables or turning pages. So the first question is asking us to find the reserve value at the beginning of the year. So this person is exactly 55-year-old. So we need the reserve right now. Let's write out the formula. What's going on? It's this thing, sorry. Off. Claims plus the expenses minus future office premiums. So since there's so many bodies to this equation, I'll just do one by one. We'll start with the expected present value of the claims. So the claims, so there's going to be one claim of 60,000. The amount is 60,000, and now we must remember our contingencies, which notation we would use here. Now for this one, we're using the capital A 55 because this person is 55 well now. And remember when we spoke about when we first introduced these notations, that capital A 55 literally means the expected present value of a whole life insurance benefit for a life age 55, which is tabulated. We have that value there. Pop that in the calculator. Cool. Now let's do the expenses. We only had that one expense. There wasn't too much here. They can make it more difficult maybe by complicating this, but this wasn't expensive. It's straightforward. 85 in advance. 85. And now we're using this one. Paid in advance for a 55-year-old. Which this number is tabulated. We have it over there. Put this in a calculator, we get sweet. Now let's do EPV of future OP. So these are all the claims, not the claims, sorry, the premiums that this insurer is expected to receive in the future. So this is like an income for them, which is going to be, it was 1,600, pretty sure. We're working with dollars, yeah, 1.6, and we're again going to be using this 55. You can go to let me just make some more space here. Yeah, that should be good. Cool. Which was tabulated. We have that amount, 1,600, 14.327. Calculator. 22,923.2. Yes. So now let's calculate the reserves using this original formula. We'll just sub in all of our values there. So EPV of the reserve at time 0, like right at the beginning. They said at the beginning of the year, and this person is exactly 55. Is going to be equals to, let me do this in blue, claims plus expenses. So the value of claims is there, 26937.6, plus expenses, which was 1217.795, minus future office premiums that we're expecting to receive, 22,923.2, which gives us an answer of, calculator, 5232.195. So do this, 52320, and we're working with dollars. So that is our first answer. Second question, find the gross premium policy value at time 10. So this, all that this means was gross premium policy value. That just means that's all that it means, right? I don't really understand why it means that. If you understand, maybe you can reach out to me and explain to me. I can't be explaining this thing when I don't really understand it, why it means that. It's just one of those things I have to accept and move on with. But yeah, so when we have to calculate this gross premium policy value at time 10, that means this question said that this person is exactly 55, right? So to calculate at time 10 means that 10 years have passed since this policy has been written. Now this person would be 65. So we're working with the A65. I don't put those values, we'll get them now. We're going to be working with A65 and this one. And I'll put the values here now. Cool, so let's get into it. It's going to be exactly the same as the previous policy. However, now we're just working with time 10. So I'll write this. So we'll start with claims again. So this is just one claim. It's still the death benefit, the whole life death benefit of 60,000. Only difference is now our person is aged 65, for which we have the value 60. Put that in a calculator. Do we get cool? Now we'll do of expenses. It's still just that 85, and now we're doing it in advance still. However, the person is 65. Pop that in a calculator. No, sorry. Don't know what I'm writing here. Small a. It's not, can't be that. That doesn't look right. 0.737. Hope you noticed that. Now we'll pop in the calculator. And cool, lastly is going to be the EPV of our future office premiums that we're expected to receive. Not 85, 1.6 dollars. Looking at dollars. Capital A. No, not capital man. What's going on? Small a. If you don't understand why we're using the small a and the big A, maybe refer to my previous video where we introduced these notations. We've got the small a value 10.737. Pop this in a calculator. Cool. Now we just put this all into our formula here, and we'll check what our answer is going to be. Let me do this again in blue. Start with claims. We calculated our present value of claims to be 35223 plus expenses, which were 912.645, minus our office premiums expected to receive is 17179.2. In a calculator, answer is 18956.445, which we can round to 18956.45 dollars. Cool. Let's interpret our answers real quick. I'll do it in red. So when this person was aged 55, we only needed a reserve of 5,200 and something. Now we need a reserve of 18,000. That's a whole lot bigger. So to think of this intuitively, let's see what's actually going on. You can think of it like this. The cost of insurance is increasing with age because mortality rises. Mortality is the death rate in a population, the probability that a life is going to survive. The probability of someone surviving longer is going to decrease at these higher ages, so the probability of them dying is going to increase. So the probability of paying out this whole life, the whole life benefit, the 60,000 is going to increase. So in the earlier years of this insurance product, right, the premium payments were exceeding the cost of the insurance plus the expenses. But now in later years, the cost of insurance is exceeding the premiums because, as we said, the cost of insurance is increasing with age due to the increase in mortality. So there's not much to this reserve calculation. It's quite fun, bit of a mix of a bunch of different aspects that we've been doing. So I hope this helped. Keep well, enjoy.